Okay, so we are talking about corporate governance terms, and these are again just some more terms. I will go over a couple, and these are items that you need to just read a few times and understand. But if you get the core concept, it's easier to remember. When we talk about the tag along, drag along rights, so these are contractual obligations in share repurchase agreements that ensure any potential future acquirer of the company may not acquire control without extending an acquisition offer to all shareholders, including the management of the company. So this is talking about, let's say this is a portfolio company. Somebody can't just acquire a partial share of this portfolio company. What's the point here? Who are the owners of this company in the way we've discussed it so far? We have the management that owns a share, the GP and the LP. So this tag along, drag along means that if somebody is buying this at a high price, he needs to bring along everyone. So does that align interests? It does. So that's the point there. No fault divorce. What does this mean? A GP can be removed without cause provided that a super majority, generally above 75% of LPs, approve the removal. Okay, so this is giving some power to the LPs. If for whatever reason 80% of the LPs want to divorce, get rid of the GP, can they do so without having any formal reason? Yeah, so they don't need to make it public, but they can. Okay, so anyway, I think those are the two most important ones. The rest you can just read. Okay. What are the risks and costs of investing in private equity? Again, these should be rather obvious, and all you need to do is read it once. But based on a general knowledge of private equity, do you think private equity is a somewhat more illiquid investment relative to conventional forms, conventional investments? Yeah, you didn't have to read all this to know that, but so generally they are illiquid. Unquoted investments, what does this mean? Yeah, most portfolio companies that we invest in are not listed. So does that create valuation issues? A lot of subjectivity? That creates a lot of subjectivity in valuation. End of the day, even though we try to align interests, is there a heavy reliance on the management of the investee companies? You have to trust them. So there are some agency risks involved. No matter how good our terms, our corporate governance structure, our term sheet, but still there is a risk that the management at the portfolio company will not be acting in everyone's best interest. Okay, so again, I want you to read the rest, but end of the day, it will be fairly, I think, a question about this. Key points are, at least from my experience, illiquid and difficult to value, okay, because of all the private companies involved. Okay. Costs associated with private equity investing. Again, just off the top of your heads, do you think it is more expensive relative to conventional investments to invest in private equity? It obviously is. Generally, and what are the components of that higher cost? Transaction fees. You need to do a lot more due diligence. So if you are that fund that is investing in private, in these portfolio companies, do you just go and invest money, or do you need to spend a lot of time, energy doing due diligence? You need to do that. So there are explicit as well as opportunity costs involved there. Investment vehicle fund setup, that fund that you set up, all the legal costs and the mechanics associated with setting up that fund, those costs are involved. There are administrative costs. From a LP perspective, you need to pay the GP, management fee, performance fee, and so on. You need to compensate the management of the portfolio companies. So when they exercise all their equity, their options, etc., there's a cost associated with that. Bottom line is that private equity investment has high transaction costs. So why would people still invest in private equity? Yeah, you would only do that if you are expecting very high returns sufficient to compensate the risks we just talked about and the costs that we just talked about. Okay. So what do we mean by due diligence investigations by potential investors? Okay, now this is from the perspective of a LP. So the core point is this: if you are investing in a private equity firm, as an LP, you want to identify the firms that you believe are the best performers. And here are some core points. Private equity funds tend to exhibit strong persistence of returns over time. This means that top performing funds tend to continue to outperform, and poor performing funds tend to continue to perform poorly or disappear. So the core point is, if you are an institutional investor that wants to put some of your money in a private equity firm, it's extremely important to figure out which private equity firm has been doing well over the last few years. Because lots of data has shown that the good performers continue to be good performers. Okay, so that's, now whose perspective is this? It's a LP perspective. The other point is that there's a big difference between the good and the bad. Okay, the point here being the performance range between funds is extremely large. For example, the difference between top quartile and third quartile IRRs can be about 20 percentage points. And finally, liquidity in private equity is typically very limited, and thus LPs are locked in for a long time. On the other hand, when private equity funds exit an investment, they return the cash to the investors immediately. Therefore, the duration of an investment in private equity is typically shorter than the maximum life of the fund. Okay, so this is along the lines of what we talked about. I think these 2 points are important. Bottom line is, as an institutional investor who is putting money in a fund, you need to do a fair amount of due diligence. Okay, private equity fund valuation. I don't think this is an overly important slide, but just the general point is worth noting that in general, so the description of private equity valuation in a fund prospectus is generally associated with the fund's calculation of NAV. Do you remember what NAV is from before? Net asset value, total value of assets less liabilities. NAV is generally defined as the value of fund assets less liabilities corresponding to the accrued fund expenses. The fund's assets are frequently valued by GPs depending on their valuation policies in the following ways. And these 5 or 6 items over here are simply saying that there are different ways of valuing. Either you value at cost and make adjustments, or you value at lower of cost or market, and so on. So I don't think this is hugely important. The core point is that as an investor, you just need to realize which method is being used to value the portfolio companies. So now let's talk about how we evaluate a fund performance. Okay, so you need to understand all the terms on this slide, and based on these terms, we are going to do a whole case study. So it's critical that you understand these terms, otherwise you'll be in trouble. And all these are just seemingly complicated terms for very simple stuff. So concentrate and make sure you understand this. The first core point is that generally funds are evaluated based on their internal rate of return, or IRR. But then the question is the following, and again going back to our basic framework, you have your general partner in the middle, you have your LPs, and then you have your portfolio company 1, portfolio company 2, etc. So your various portfolio companies. Now when we talk about IRR, the question is which IRR are we talking about? Let's say we have a very simple private equity company with just one fund. Okay, so now what is the return of this fund? This fund puts money into these portfolio companies, and then these portfolio companies generate a return. So let's say this portfolio company, we invested 2 million and we got back 3 million after 2 years. For the next portfolio company, we invested 5 million and we got back 8 million after 4 years, and so on. Okay, so what is the IRR? The IRR is simply based on looking at all your cash flows and looking at your effective return. When we talk about gross IRR is from the perspective of the general partner and the portfolio companies. So if we look at it from the perspective of the general partner and say, okay, what are my total cash outflows and what are all my inflows? And based on that, when we calculate an IRR, that's your gross IRR. Okay, now when you take the LP perspective, the LP is putting money into the fund and then the LP is getting money back. But the money that he gets back is based on this money generated from the portfolio companies plus all the fees and the carried interest, etc., that is given to the GP. So when we are looking at the flow or the perspective between the LP and the fund itself, this is your net IRR. Why is it called net? Because all the fees are netted off. Okay, so in general what you've learned is gross IRR is your return without netting out the fees. Your net IRR is the IRR once you net out the fees. But it's also useful to look at it this way, that from a LP perspective, he would be interested in IRR, and from a GP perspective, he's interested in the gross IRR. Okay, so that's this point. The other larger point is that in general, when you look at evaluating private equity firms, the most commonly used metric is IRR. Okay, so that's the big picture. Now, let's make sure we understand each one of these terms. PIC stands for paid in capital, and I'll actually write all these things down so that you memorize this. So PIC is paid in capital, and this is paid in capital as a percentage of total committed capital. The point being that let's say that in a given fund, the initial amount of capital committed was 10 million. The paid in means how much money have the investors actually put in. So if the investors have only put in 6 million, then what is PIC? So it is 0. It's a fraction, so it is, or a decimal. It's 0.6 or 60%. Okay, so everybody understands what PIC means. All these terms, actually, just as a quick point, all these terms are just fractions or decimals. Okay, so this 0.6 means that for every $1 committed, 0.6 has been actually paid into the fund. Okay, so that's your paid in capital. The DPI stands for distributed to paid in. So I will put it distributed divided by paid in capital. So this means that how much money has been given back to the investors. So the point here is, continuing with my simple example, if investors have given 6 million to the fund and the money that has been received back by the investors, remember that there are several portfolio companies. So let's say that so far the fund invested in 3, of which the first portfolio company has been sold off and 2 million is returned to the investors. So if 2 million has been returned, that's the distribution. Distribution you can think of as the dividend. Okay, that's the money that is going back to the investor. So if 2 million has been coming back, then what's the DPI? It is 2 divided by, it is all relative to the paid in capital. So that is 2 over 6 or 0.33. Okay, the residual value to paid in, this is, I gave you a simple example where there are 3 portfolio companies, portfolio company 1, portfolio company 2, and portfolio company 3. Let's say that the investment in this portfolio company 1, you invested 1 million and you got back 2 million. But the rest of what you have contributed, the remaining 5 million, and when I say you, I am basically saying that you have a LP perspective. The remaining 5 million is locked into portfolio company 2 and 3. Okay, at this point, these investments have not, these have not been sold, so your money is stuck over here. But based on techniques that we mentioned earlier, the valuation of these companies leads us to believe that the total value of these companies collectively is 8 million. Okay, does that make sense? So we haven't gotten this money back, but using private company valuation techniques, we figured that the combined value of portfolio company 2 and 3 is 8. Okay, so the residual value to paid in capital would be the residual value, which is the 8. So that would be 8 divided by 6. Is this of interest to you as a limited partner? It is of interest, but clearly this is more subjective relative to the distribution means you've received that money back, you've realized your return. This from a LP's perspective is not realized, but still you want to know that my money is invested in these companies, what's their value. So this is 8/6, okay? So that's the RVPI. Any guesses? So Atiq, what do you think TVPI will mean? Yeah, this is the total value paid in. So given what I have talked about, say you are an LP, what's the TVPI?
10/6.
Yeah, so it is 2/6 plus 8/6. So total value to paid in is 10/6. So this is saying that of your 6 investment, 2 you've gotten back. So the way you can think of this is 2 is what you got back. That's your DPI. Plus the 8 is sort of in the bank. That's your residual. So the TVPI is 10/6. Okay, so this is also your quick refresher on fractions. All right, so you need to know all these terms. All right, now read this and we'll then talk about it. And this is warming you up for a huge exercise that's coming up next. Okay, so let me go through this and make sure that you extract the core points. Suppose that a private equity fund has a DPI of 0.07. Okay, so exactly. So for every dollar that you have put in, you've gotten back 7 cents. So the other Harun, what does this RVPI of 0.62 mean?
The balance.
No, the other Harun, no. Exactly. So now for every dollar that you've put in, the value that is still stuck in the companies or still there in the companies is 0.62. So do you think you are a happy investor at this state? No, because relative to, so what's the TVPI? Yeah, so for every TV is, the TVPI is 0.69. That means for every dollar that you've invested, your worth right now is 69 cents. Okay, so this is after 5 years, so that's been a substantial period. IRR, as you can imagine, is negative, clearly bad. Not only, even an IRR below your cost of capital is bad, this is an IRR that is well below zero. The fund follows a venture capital strategy in high technology, has a vintage year of 1999. So Basit, what does that mean, vintage year of 1999? Yeah, so vintage year is the year in which a fund starts. Okay, so and a term of 10 years, so that means that like most funds, this is a 10-year fund. Okay, now this is actually not a question, this is just this is actually explaining things to you. A DPI of 7% indicates that few successful exits were made. Okay, so it's saying that very few successful exits were made. RVPI of 62% points to a extended J-curve effect. How many people have heard of this J-curve? Okay, so it will keep coming up. A J-curve simply means that when you make an investment, especially in areas such as private equity, it is reasonable to expect that initially there will be losses before you will have gains. Okay, now this is an extended J-curve. So what does that mean? Okay, that means that this loss period seems fairly long. We are 5 years into the fund and we are still in, if we started at 100, we are now at 69. Okay, so we are in this dip. So this is a useful technique to use at work. If you are asked to make an investment and the value is down, you can tell your boss that we have simply experienced the J-curve effect. Okay, if it goes on for a while, then tell him that it's an extended J-curve. All right, so this is that's just a fancy way of saying that we've been losing money for a long time. All right, so this is an extended J-curve effect. For a fund, TVPI amounts to 69%. So halfway through the fund, a 10-year fund, this is a pretty bad state to be in. A vintage year of 90, now I don't know if you know this or not, but the internet bubble burst big time in 1999, 2000, so in this time. So provides hints that the fund was actually started before the technology market crash. So the fund was started at the peak of the internet and the technology boom. And obviously this makes sense. Even if you look at NASDAQ, which is mostly technology heavy, that has not even recovered to its 1999 level. That's a side remark. Okay, and I personally got badly burnt over here, so I know this well. Okay, and the routes to exit for portfolio managers have been dramatically changed. So during the technology market crash, the investment portfolio probably suffered a number of complete write-offs. In this situation, an LP should thus consider the state of the existing portfolio to examine the number of write-offs and other signals of ailing companies and so on. So the point over here is maybe even the 69% is overstated because of the destruction that happened to technology companies in 2000, 2001 and so on. Okay, so that was just warming you up for this. Okay, now I'm going to set the context. I've given you all the numbers. If you listen carefully, then you will not have to go through this whole segment, which can take you a while to absorb. Okay, imagine that you represent this company called Icarus. So you are an investor. You have invested in a fund called EVP1, and then again you invested in a follow-up fund from the same company called EVP2. Okay, so the top half of this slide gives the overall perspective for EVP, and the bottom half gives the perspective gives your perspective. You represent this institutional investor called Icarus that put money in this fund. First, let's just look at what EVP1, this is a venture capital fund. What did the fund do? Vintage of 2001, what does that mean, Basit? Yeah, that's the year in which it started. Actual fund size means that the committed capital was 125. The capital called, what do you think this means, Sharik? Yeah, this is like the paid in capital. This is how much has been called in. When a private equity firm starts, it doesn't call in the entire committed amount. It obviously calls as it identifies portfolio companies. So that's 92. Okay. And what about the management fee? The management fee is 2%. Carried interest is 20%. The hurdle rate, what does carried interest? 20% represents that the GPs can claim 20% of the profit if if the profit exceeds 8%. The term means that this fund is expected to go on till 2009, so it's less than 10 years, it's shorter than average. And the report date that you will see below, so everything that we are discussing is as of end of 2006. So this was fund 1. Then this company also launched a second fund in 2003. That's the actual fund size and that's the data. Notice that why is the called in amount less? The called in amount it started later, so the called in amount is less, but interpretation is the same. Now the bottom part is what you are interested in. Okay, so this is the money you have committed 10 million to the fund, of which you have already contributed 9.2. The gross IRR so far is 16.1. The net IRR is 11.3. You are the institutional investor. Which number is of more interest to you, the gross IRR or the net IRR? Yeah, because you are the investor, the LP effectively, so you are concerned with this number. The DPI is 1.26. Okay, so Fawzan, what's the interpretation of this 1.26? Yeah, so that means every dollar that, so can you tell me how much money have you actually, given this data, how much money have you actually gotten back from EVP1? Exactly. What you have gotten back in dollar terms is 9.2 multiplied by 1.26. So you recouped your investment. And then RVPI is 1.29. So Exactly. So if you value the portfolio companies that have not been sold off yet, that amount is 1.29. Okay, so what about, yeah, so 2.55 is the sum of the DPI and the RVPI. So are we experiencing a J-curve effect here, or we are past the dip? We are past the dip. This looks like a fairly good picture. What do you think this quartile 1 stands for? Yeah, so this is a fund that is in the top quartile. Most private equity funds will be put in a quartile. Obviously, the best place to be is the top quartile, which is where you need to be with the result of this exam also, okay, in order to pass. All right, so that's a good picture. What about the second fund? Does it make sense that DPI is only 0.35? Yeah, so it's a newer fund, so the DPI is lower, the RVPI is lower, the TVPI, at least it's more than 1. So you are overall in positive territory. This has not performed as well. Maybe it will perform better later. Okay, so this is an interpretation of the numbers. Okay, now getting deeper into EVP1. Okay, let's, this is the data on calls, operating results and distributions. What this means is, for this particular fund overall, in 2001, called down 50 means that the fund took in, so if you look at the fund, so this is the overall fund EVP1. So in 2001, it took in 50. So at the start of 2001, that went in. Over the year, it invested in portfolio companies. So let's simplistically say that it invested in a portfolio company right up front. And at the end of the year, the value of that portfolio company was 45. Okay, so realized results means that the portfolio company was not sold, hence the realized result is 0. Okay, no return has been realized from a fund perspective. What does this -5 mean? That the value of the investment has gone from 50 down by 5. So that's our operating performance in year 1. Distributions 0. Does that make sense? Yeah, so nothing was distributed back to the LP. Distributions means the money that is being given to the LP, and that's what in this example we are the institutional investor, which is the LP. What happened in 2002? Another 15 million was called down. Again, realized results 0. What does this mean? That in 2002 nothing was sold, no portfolio company was sold, so there were no exits. Do you understand the term no exits? An exit is where a portfolio company is sold. Unrealized result -15. Are we still experiencing a J curve here? Yes. Yeah, so we are in negative territory. So our total unrealized losses are 15. Still no distributions. Then in year 3, we start moving up. Another 10 is called realized results 10. This means that we actually made an exit now, and we gained 10 on the exit, and other investments that we have not exited, their value has gone up. Okay, but still we have not distributed. Is it possible that the fund has made an exit but money has not been distributed to the LP? It's possible. The money is still sitting in the fund. It's not being distributed out to the LP. So that's what happens in 2003. And the last, I'll go over 2004. After that, everything is self-evident. So in 2004, additional money is called in. The realized results are great in the sense that we made a few more successful exits. Unrealized results are decent. And now, finally, 3 years later, LPs start to see some money. Does this highlight the relative illiquidity of private equity investing? From a LP perspective, you better have the patience to wait for at least a few years before you even see some of your investment coming back. And the riskiness is also there because the portfolio companies might not end up doing so well. Okay, so anyway, then the rest of the data should be self-evident. Now, let's look at cash flow and distributions, and this will help us calculate IRR. Okay, I hope everybody is clear about this picture up here. Now, in 2001, call down 50, where did this come from? That's the money that's called down. Okay, the paid in capital is 50. What does that mean? Yeah, so paid in capital is how much has been paid in. So for 2001, the call down amount is paid in. Management fee is 1%. Where do you think this came from? Actually, management fee, if you recall from our earlier discussion, is always going to be a percentage of something. Typically, it's, as in this case, it is, we are given that the management fee is 2% of the paid in capital. So 2% of 50 is 1. So that's where the management fee comes from. What are the operating results in 2001? Minus 5. So that comes from there. The NAV before distributions. Anybody can tell me why the NAV is 44? Yeah, we lost 5. Then why is this not 45? Yeah, the management fee of 1. So net impact is that you are down to 44. There are no distributions here, so the NAV after distribution is the same. Okay, then what about next year, 2002? Additional 15 is called down. That's this number in 2002. Okay, so that's called down. Then paid in capital 65. So Sharik, where did that come from? Yeah, so 50 was paid in earlier, now another 15. 1.3 comes from where? 2%. That's the 2% of paid in capital. Operating results of minus 15. That's the operating results in 2002. The NAV, where is this coming from? So that's the paid in capital minus the, so minus all the losses, which are 20 so far, and minus the fees. Okay, so that's 42 and so on. Let me just jump ahead now to 2004. So here another 25 is called down. The paid in has gone up to 100. Management fees a nice 2% of 100. Operating results in 2004, if you notice, are the operating results stands for both the realized as well as the unrealized results. So that's 45. So the combination of those two is over here. The NAV we calculate in the same way. Now finally, since we are, so look at this NAV before distributions. So now the NAV is above the paid in capital. So finally the GPs can get some carried interest. Okay, so the GPs get carried interest. In this year 2004 we also have distributions. So if there are distributions of 25, does that reduce NAV? Okay, we come very, as in this, do you see an analogy between this and a regular company? So this NAV can be thought of as the equity. The distribution can be thought of as the dividend. So when you pay out the dividend, what happens to the equity? That comes down. So this is going out as cash. So obviously the equity or the NAV goes down. Okay, and then the same logic goes through 2005 and 2006. Now, where do you think we are going with this? You want to know, how do you ultimately measure the performance of a private equity fund? You are concerned with the IRR. So overall, what return am I getting? Okay, so we'll do that and then conclude this segment. Okay, this top part is the operating results that has been cut pasted. So that's what you just saw. Now we want to create a cash flow. 2000, all these numbers stand for year-end numbers. So so the end of 2000 is the same as the beginning of 2001. When was that initial investment of 50 made? It was made at the start of 2001, which is the same as end of 2000. So since we are talking about year-end numbers, does this minus 50 initial cash flow make sense? So if you have your timeline, time 0 is what? It's the end of 2000 or the beginning of 2001. So what's your cash flow here? Minus 50. Net cash flow means how much money is the LP getting after fees have been paid. So initially minus 50 at the start of the fund, so the gross and the net are the same. Okay, 2001, so over this year, where is this minus 20 coming from? Again, we are looking at a pure cash flow. So 2001 means end of 2001, which is the same as beginning of 2002. What is this call down amount? This is the money that you contributed when? Beginning of 2002, which is the same as end of 2001. So you have minus 15. Okay, what else? Now the way this calculation works is, even the unrealized results you count as a cash flow. Okay, one can dispute or debate that, but the way this works is, even that, so the sum of these two is what you consider. So that's minus 5. That's without any fees. In addition, in this year, how much fee did you pay? Do you remember from the last slide?
1.
You paid a fee of 1. So what's your net cash outflow? Minus 21. So without the fee, the cash outflow was minus 20. And then when you count the fee, then your cash outflow is minus 21. Okay, and then you use the same logic. Where is this minus 25 coming from? So that minus 25 is coming from the 10 which was called down at the beginning of 2003, and your losses for 2002. So the sum of these two, minus 15, so call down minus 10, another loss of 15. So these combined make minus 25. And what about the minus 26.3? That's including the management fee. Why is this 0?
25 minus 25.
Okay, so now we are, for the year 2003, what was your initial cash outflow?
25.
You gave out minus, so that's the minus 25. And then how much did you get?
25.
You got 25, 10 in as realized and 15 in as unrealized. So the net effect is 0. So you use the same logic to come up with the rest of the cash flows. And then how do we come up with the IRR? You simply plug into your calculator and your gross IRR will be 16.1 and your net IRR will be 11.3. Okay, so at least once or twice you need to go through this example and make sure you understand it, because I think this is fairly testable.
This is the IRR, but it's based on profits.
Yeah, it is IRR. It's based on a combination of the money that you contribute plus both realized and unrealized gains. Okay, typically when we look at IRR for a project, we look at net cash flows. So this is an adjustment to what we normally do. But this was the procedure that you have to apply when you are coming up with the IRR of a private equity fund. All right. Now we will go over the appendix, and the quick story behind this is 2 years ago I skipped this appendix, saying that the probability of the appendix showing up is so remote that we'll just skip it. And then I got lots of angry calls after the exam that a question on this did show up. So after that, I make sure that we do this. Okay. Chances are this would show up, but since it is explicitly a learning objective, I think it's interesting. So let's do it. Okay. And there's a lot of stuff in there. I'll try and take out what I think is most testable and the most significant. So the idea is this. This is a note on valuation of venture capital deals. So we are back in the world of VC. So VC means we are investing in startup companies. The data given to us, now we need to, I'll just tell you who are the players involved over here. We have a VC company called Vulture Ventures. So somebody was having fun with names. So we have a VC company that is providing funding, and then we have the actual management of the company in which money is being invested. Now, is there an interest on both sides to realize what the value of the company is? There is, because that's how we figure out who has how much share. Who are the two players? The VC and the management. So we are given these assumptions. The terminal value of the company, so this is time 0, this is terminal value. We are expecting that the company will be sold after 4 years for 25 million. Okay, let's say that the VC company and the management agree that given this business, we'll be able to sell it after 4 years for 25 million. So we are given that. The VC today at time 0 wants to make a investment of 3 million. Okay. Now, given the riskiness, do you think this is a risky cash flow? It's just one cash flow after 4 years. So this is a fairly risky cash flow. What's one way of dealing with risky cash flows in the future? Use a very high discount rate. Okay, so rather than spend too much time debating about whether this is likely, not likely, the VC company, rather than, who do you think is pushing for a high number? The management is saying that we are going to have a very high number. So if you are a VC, would you like to argue with them that no, it's unlikely that you have that higher number? As a VC, you would like to be showing a lower number so that the valuation is lower. If the valuation is lower, then your 3 million will give you a higher percentage. Okay. On the other hand, the management would want a very high number, because if they can convince the VC that the value will be high, then the value of the 3 million investment in percentage terms will be lower, and the equity stake of the management will be higher. So if you are a smart VC, rather than debating too much with the managers, you just say, okay, value is 25 million, but you use a very high discount rate, which makes the present value of this 25 relatively low. Okay. So anyway, you are given that 50%, and the management team, they like the 1 million number, and they say that whatever the distribution, we want 1 million shares at time 0. Okay, so this is the data given to you. Does this mean that the total number of shares will be 1 million at time 0? No, this is the shares for the management. There'll also be a share for the VC. Okay, now how do we do this valuation? It's a simple 6-step process. Step 1 is to determine the post-money valuation. Okay, so the point is, the post-money valuation, this means that we are saying that this company will be worth 25 million if the 3 million investment is made. Okay, so if the 3 million investment is made, then the company will be worth 25 million after 4 years. So if it's worth 25 million after 4 years, what's the value of the company today given a 50% discount rate? Okay, so that's 25 million over 1.5 to the power of 4, which is, so this is 4.94 million. So is this the post valuation? Post what? Zubair, why is this called post money valuation? So post the investment of 3 million, the value of the company is 4.94 million. At what stage? Time 0, time 1, time 4? Time 0. So at time 0, assuming the 3 million investment has been made by the VC, the value of the company is now 4.94. What do you think? Any other guesses on step 2? Very good. Okay, so step 2 is determining the pre-money. Good job, Arun. Okay, so that's the pre-money valuation. So Mubin, what's the pre-money? No, tell me a dollar figure. We just said that post was how much? 4.94 4.94. So what's the pre-money valuation? Yeah, so the pre-money is simply the post minus the, this is one of the easiest formulas that you'll need to remember. So this is 4.9 minus 3. So that is 1 point. So your step 2 is determining the pre-money valuation. So that's the valuation, so pre-money valuation. Step 3 is determine the ownership fraction. Okay, so now who owns how much? So if, how much does the VC own? What percentage or fraction does the VC own? Yeah, so VC will own 3 million divided by 4.94, which is approximately 60%. And how much does the management own? The rest, which is 40%. Okay, so is that simple? Now, obtain the number of shares. How many shares do we have in total? 1 million is for whom? Management likes to say that we have 1 million shares. Does that mean, so that 1 million shares is for management, but if this is 1 million, then 60% will be how many? So that must be 1.5 million using simple maths. So what's the total number of shares then? So the total number of shares is 2.5 million. Okay, if this is the total number of shares and we have a post-money valuation of 4.94, what's the price per share? So the price per share is 4.94 divided by 2.5, so that will give you your value per share. Okay, so this is probably the most important part of that appendix, not too difficult. Okay. Next, actually, this learning objective says that we also, given that generally private equity firms, VC firms talk in terms of IRR, we need to phrase this exact same problem in terms of IRR. How do we do that? Okay, now a VC might say that we actually, so a VC might demand a certain return. Okay, so the way we are going to look at this is, let's say that the VC is demanding a 50% return, or VC requires a 50% return. All right, if the VC is requiring a 50% return and the VC is investing how much money? As before, the VC is investing 3 million. So how much must the 3 million become at the end of year 4? So 3 million, if he's demanding a 50% return, then the 3 million must become 3 multiplied by 1.5 to the power of 4. And that's what the W is, the amount of wealth investors who are here, the VC, expect to accumulate. So the wealth W is equal to the investment amount, which is 3, into 1 plus R, which is 1.5, to the power of T, which is number of years. So if you do this math, you will come up with 15.2 million, of approximately 15.2 million. Okay. Next, you need to determine, so F is the fraction of share ownership required by investors. How will we come up with this? We know that what's the value at the end of year 4? What's V? V is already given at the end of year 4. Like, this is the same problem as what we did on the previous slide. So we are making an assumption. The management and the VC, who's the investor, collectively, jointly agree that after 4 years, the company will be worth how much? 25. And of that 25, how much is the VC wanting? 15.2. So what's the fractional share of the VC? It is, so that fraction is equal to 15.2 divided by 25, which is approximately 60%, which is what we just did. And then the rest is fairly simple. So if that's the share of the VC, then the share of the management is 40. Okay, next, why, step 3 is the number of shares for the investor. How do we do that? Same procedure. So how much did the management want? How many shares? 1 million. So this means that the investor has 1.5 million shares, and then you can figure out your price per share. How do we do that? So the price per share in this method, what's the investment? How much investment was made? The investment was 3 million divided by the number of shares. So what's the number? What's this Y over here? It's P1 is the price per share. It's the investment divided by the number of the VC shares. So that gives us approximate. So given our approximations, this is approximately 2. And then post is the post money valuation, which is the share price multiplied by the total number of shares, which is 1 million plus 1.5 million. And then the pre-money valuation is the post minus the investment. So it's just a different way of coming to the same conclusion. Okay, the final slide in this reading. Okay, when we talked about risk, that 25 million after 4 years, was that risky? Okay, so what are 2 ways of dealing with the risky cash flow? One way is to use a very high discount rate, which is what we did in this example. How many of you remember level 1 venture cap in your alternative investments reading? There was a small, or something that appears small right now, might have not appeared so small back then, but there was a small segment on venture capital, right? Do you remember how you did the valuation there? Okay, what you basically said is you took a probability weighted terminal value. Remember we said that we had these probabilities of failure every year, and then we came up with what's the probability of success, and based on that probability we weighted the cash flows. So another way of dealing with risk is to associate a probability with those cash flows. So use a normal discount rate like 15% or 20%, but basically weight down the cash flow based on probabilities. So that is another method that you can use. Okay, and just as a quick recollection, let's say that the possible terminal value is either 60 million or 40 million or 0. So you take, and let's say each have a 1/3 probability. So you do a probability weighted average, and rather than taking 60 million and discounting at a high rate, you take 33.3 million and discount at say 20%. Okay, so from an exam perspective, you just need to know that these are 2 different ways of dealing with risk. Okay, so that brings us to the end of this rather long reading. I think with alternative investments, about 5 to 15% of your exam, fundamentally there are 3 parts to it. There was real estate, 2 readings, private equity, and then hedge funds, which we will do next. This, I think, in my opinion, is the most likely one to be tested